What is the stock market and how does it work? The stock market is an exchange mechanism that enables investors to buy and sell shares in publicly traded companies, serving as a critical part of modern economies where businesses raise capital to accelerate startups, expand operations, or consolidate and pay off debt. While the New York Stock Exchange, NYSE, and NASDAQ are prominent components of this marketplace, most trades occur electronically between participants who are geographically remote. Public companies, listed on stock exchanges, must adhere to transparency and reporting regulations, and their shares are open to institutional investors, high-net-worth individuals, and those with modest means seeking income from dividends, potential stock appreciation, or influence over company decisions through voting rights. The U.S. stock market is regulated by the Securities and Exchange Commission (SEC) and state regulators, ensuring fair practices. Stock prices fluctuate based on supply and demand, driven by company performance, economic conditions, investor sentiment, and other factors, with each investor often applying different criteria when making decisions. This dynamic keeps shares trading actively and makes future prices difficult to predict. Some investors hold stocks for dividends, others aim to buy low and sell high, while some seek involvement in corporate governance. The terms stock market and stock exchange are often used interchangeably, though exchanges like the NYSE and NASDAQ are components of the broader market. Analysts use indexes as snapshots to gauge the market's health, and the system as a whole plays a vital role in enabling money to flow between investors and businesses, supporting economic growth while being safeguarded by regulations against fraud and unfair trading practices.